During the GFC, the widespread asset liability mismatches of banks and shadow banking institutions led to a vicious cycle of fire sales, asset devaluation, and margin calls. How did the vicious cycle materialize? Let's start with the asset liability mismatches that created pressure. As we already heard in one of the previous lectures, and to reiterate, financial institutions held long-term illiquid risky assets. On the asset side, these were funded by short-term liabilities that had to be rolled over frequently. When asset quality came into question, meaning rising subprime defaults, investors pulled funding or refused to roll over short-term debt. Or in other words, short-term funding disappears. That leads to forced liquidations. The fire sales begin. Institutions facing liquidity stress were forced to sell assets quickly, regardless of price, to meet maturing liabilities, redemption demands, margin calls from repo or derivatives positions. That obviously entails that asset prices collapse, because many firms held similar structured products. Like MBS and CDO's fire sales drove down market prices. Illiquid markets couldn't absorb these sales, leading to sharp price drops. Even performing assets lost value due to market illiquidity and not their fundamentals. A crucial role here played the practice of mark-to-market accounting that amplified the problem. Under mark-to-market or fair value accounting, institutions had to write down the value of assets to reflect depressed market prices. This led to immediate loss recognition on income statements and the erosion of capital ratios. As capital buffers shrank, that raised fears about insolvency. Creditors and investors lost confidence, pulling back funding even more. What's the consequence of that? Margin calls and downgrades. Falling asset values triggered margin calls on repo and derivative transactions. Credit rating downgrades increased haircuts on collateral, requiring even more cash or collateral. And institutions were forced to sell more assets to meet these calls, fueling further price declines. This led to more fire sales, also in assets that deemed to be secure, creating a liquidity spiral and balance sheet insolvency even for otherwise solvent institutions. As the vicious cycle is unfolding, let's place emphasis on this particular aspect of mark-to-market accounting, in particular with respect to the previously introduced concepts of trading book and banking book. In theory, and to reiterate, the distinction between the trading book and the banking book should have limited the damage. Trading book assets held for short-term profit were subject to daily fair value adjustments, while banking book assets meant to be held to maturity could have been valued at amortized costs. But as the crisis deepened, even banking book assets were sometimes repriced or reclassified, spreading the contagion. Accordingly, what is the reason behind to suspend or relax mark-to-market accounting? Firstly, market prices became dysfunctional. There were no active markets for many structured products due to the fire sales. Prices did not reflect the fundamental values. Secondly, accounting losses didn't reflect credit risk. Many assets were still performing, for example, the interest was paid, yet they had to be marked down massively in terms of the principal value. It exacerbated the crisis. Mark-to-market losses reduced regulatory capital, triggered capital requirements and margin calls. That created procyclicality. Losses forced sales, which caused more losses. Impaired banks decreased the willingness to lend. With shrinking capital, banks cut back on credit, further deepening the recession. What was the policy response? Mark-to-market suspension and accounting relief. In the US, in March-April 2009, the Financial Accounting Standards Board, FASB, allowed more discretion in valuing assets when market prices are not orderly or observable. Firms could use models, so-called level 3 inputs, instead of fire sale prices, and the result was that banks reported smaller losses, stabilized capital, and could reduce the fire sales. In Europe, under IAS 39 (IFRS), the European Union allowed reclassification of certain financial instruments from fair value through profit and loss to held to maturity or loans and receivables. This reduced volatility and MTM losses in bank earnings and regulatory capital. What were the lasting impacts and reforms? A tiered fair value hierarchy. Assets are now classified into Level 1 market prices, Level 2 inputs based on observable data, and Level 3 model-based valuations for the unobservable inputs. This hierarchy enhances transparency and gives context to how asset values are derived. Greater use of historical cost for banking assets. Regulators reaffirmed that loans and held-to-maturity securities could be accounted for at amortized cost, not fair value. Furthermore, the shift in the focus to liquidity and capital buffers. The GFC showed that valuation alone wasn't enough. Institutions also needed to be able to withstand market stress. This led to regulatory initiatives like Basel III liquidity coverage ratio, capital conservation buffers, and stress testing regimes under adverse market scenarios. You have been hearing that all over the course. To wrap up, after the GFC, mark-to-market accounting rules were relaxed to reduce their pro-cyclical effects in distressed markets. While fair value accounting was not abolished, greater flexibility and judgment were introduced to account for illiquid or frozen markets. Today, fair value is still widely used, but within a clearer framework that separates trading from banking book assets and provides transparency through the fair value hierarchy.